Hello traders, the title of the video is A Technical Trader Reflects Upon the Average True Range of Whales Wild. The average true range is also called the ATR Alpha Tango Romeo Average True Range. Alright, technical traders use the average true range, to determine the volatility of the financial instrument that they are trading. Alright, so the average true range will be rising if the financial instrument is becoming very volatile, and the average true range will be declining if the volatility is diminishing or the price is going up or down in a normal progression. Alright, so a financial instrument that is gapping up or gapping down frequently will have a high ATR or a high average true range. So the first thing that should come into the mind of a technical trader when he or she is using the ATR is the volatility, nothing else. The ATR is not a directional technical indicator like the RSI or MACD. So when we are talking about directional technical indicator, the MACD can tell us that the price is likely to go up or down. Alright, and you will be going in the direction of the price, but the ATR may be going up when the price is going down. It's telling us that the volatility is increasing. At the same time, alright, the price may be going up, but the ATR may be going down, telling us that the volatility is not as strong. Alright, so those are the things that we want to understand when we are using the ATR technical indicator. Now, going to the origin of the creation of the average true range, it was originally designed for commodities because the commodities are more volatile than stock. So it is a technical indicator designed primarily for commodity trading. All right, the commodity are more volatile and they frequently gap up or gap down. So it is not primarily designed for stock or for currency. Technical traders do use the average range, to determine the volatility for any financial instrument in the financial market. So a trader asked me today about the ATR. How we can use the ATR to set a stop loss. All right, so in a nutshell, all right, so if for instance you see here the ATR is going down, it means that the requirement for the stop loss will be higher than normal. So which means the volatility is increasing, the price is likely to gap out, we are likely to see long candlestick bar at a time when the volatility is increasing. Therefore, we cannot use the normal stop loss that we were using before. So for instance, if you are trading the euro dollar, all right, on average, if you are day trading, we can use 30 pips, sometimes even 20 pips. So personally, if you are trading, for instance, the dollar yen, all right, the euro dollar, or the dollar Swiss franc, or the euro British pound, or the Australian US dollar, the average stop loss for day trading, personally speaking, I'm talking about myself, will be like a 30 pips. Sometimes you can get away with it with 20 pips. Even for the euro dollar, sometimes you can day trade using 15 pips. But on average, personally, I do not want to use more than 30 pips when I'm trading, for instance, the euro dollar, the Australian US dollar, the British pound US dollar, the euro British pound, all right? Those are normal, volatility, all right? But sometimes if you are using the ATR and you notice that the ATR is likely to go up or is rising, instead of using your normal 30 pips, you may decide to use 40 pips or more, depending on your risk tolerance, all right? So the average rate is not directional. It may be going up when the price is going down. It may be going down when the price is rising. It's just telling us that the volatility is not, if it's going down, it's telling that the volatility is diminishing. If it's going up, it's telling that the volatility is likely to increase. So therefore, if one wants to use the ATR to determine the appropriate stop loss that one should use, one should just check the ATR, is it rising? So like here, you see it starts rising here. At that time when you are trading, so for instance, the British pound yen, this is the currency pair that I'm analyzing here. You see here in this section here, it was rising, all right? So it was rising. So during that time, if you were, for instance, day trading, all right, or even swing trading, and you notice that the ATR is rising during that time, it is more recommendable not to use your normal stop loss, but to add a little bit more, okay, according to your own risk tolerance. Right? So another way that we can use the ATR is that you see here when you went up, okay, so it's for this British pound yen, you can see that when it reaches the zone of 1.6, all right, is topping up. So you see here, it went to 1.6, it come back down, it reached this level. So you can determine the maximum, the overbought level of the ATR itself. So for instance, you see here, it came to 1.6, it came down, 1.6, it came down. Here it is, as soon as it goes above that 1.6, so from 1.6 upward, you'll be expecting the volatility to start diminishing, which means the ATR is likely to go down. So as it's going up, you are using, okay, above average, okay, stop loss to control the risk. And as it reaches the peak of that financial instrument that you are trading for, the British pound yen is 1.6. As it reaches 1.6, and you know that it's likely to top. All right. From that point, if you start turning, you see a reversal of the ATR. You start going back to your normal, okay, stop loss, which means the volatility is likely to be normal when the ATR is going down. All right. So you will go back to your normal stop loss. All right. Now, when it comes to the stop loss, I don't like to tell traders what to do. Personally, I think that over time, traders very often will determine the best stop loss for themselves. So it's through the try and tribulation that one will learn the best stop loss that one should set. All right. Then I talk about how to set stop loss at 24 Stock Trader YouTube channel, and also I think at the goo.gl channel, and I explain to traders how to set stop loss. There is a playlist, okay, at the 24 digit 4 Stock Trader YouTube channel about okay, how to set stop loss. If not 24 Stock Trader, it should be Day Pro Trader. Check it out. So you search the phrase how to set stop loss like a pro on YouTube. You see a video, a playlist from 24 Stock Trader, or maybe Day Pro Traders okay, YouTube channel. So if you are trading currencies, all right, if you ask me, okay, what should be your stop loss? On average, if you are trading euro dollar, all right, euro British pound, dollar yen, dollar Swiss franc, okay, pound dollars, okay, Australian dollar, US dollar, all right. On average, 30 pips is enough for a day trader if you are entering the trade around key level or on the edge of a trend line. Now, because traders very often sometimes they enter a trade in the middle of nowhere, that's not the best approach. You want to enter the trade on the edge of a key level, on the edge of a trend line. That will allow you to minimize the risk. All right. So the volatility may be increasing. But look at this one here. Okay, let's see this one. Okay, here it is. You see this session where it was going up. Okay, am I talking about here? It's going up. It's telling that the volatility is increasing. So during that time, the price was going up. If you draw a trend line, at least okay, a trend line, and you are careful waiting for the pullback on the edge of the trend line, though the average trend was increasing, telling that the volatility will increase, you can still okay use okay reasonable I'm choosing my word carefully, reasonable stop loss on the edge of a trend line, on the edge of a key level. Though the ATR is increasing, the volatility is likely to increase, but you can still use a reasonable stop loss during that time if you are buying or selling on the edge of a trend line or on the edge of a key levels. All right, this is very, very important. All right. So apart from the ATR, so for the ATR, another thing that you can do, you can look on the chart. So the ATR is designed for a daily chart. It's not designed for 15-minute chart. It's not designed for 4-hour time frame. So originally, it's designed for a daily chart. So the time frame that traders should be looking at the ATR should be what? Daily chart. Okay. So primarily designed for a daily chart and primarily designed for commodity because they are more volatile than any other financial instrument and they are gapping quite often. So how do you use it to set your stop loss? If the ATR is increasing, it means that you may have to use a bigger stop loss than normal. But you can still use a reasonable stop loss if you are trading on the edge of a trend line, on the edge of a key levels. Right? So if you check out again this section here, I want to show you another section here. Here it starts rising, all right? It's rising. So during that time, you will notice that, okay, I can't use my normal 30 pips or my normal 40 pips or whatever is your normal stop loss. You will be thinking that, all right, I need to add 10 pip more or 15 pip more because the volatility is increasing. But again, you see there, traders that are trading on the edge, okay, can still, enter the trade at a reasonable. So you see here, so the average range was increasing, but for instance, if for instance here the price went up and pulled back to the edge here, all right, if you were buying here, all right, you will not have to use too much stop loss. But if you are trying to enter when the price was running fast here, not on the edge, you will have to adjust your stop loss accordingly. All right, so trade on the edge of a trend line, on the edge of a pitchfork tool, on the edge of a key level from a higher time frames. All right, go to the quarterly chart, yearly chart, monthly chart, draw your key level, try to trade around those key level and trend lines from the higher time frame. If you are doing that, even if the ATR is increasing, you can still enter your trade, okay, with a reasonable risk. But if you try to buy anywhere, anyhow, not on the edge, when the ATR is increasing, you will have to increase your stop loss. All right? So apart from the peak of the ATR that we can also use, so you see here, I'm telling you that this one, the peak is around 1.6, all right? So when we see it reaches that level, we know that there's a high chance soon it will start going down, all right? So when it starts going down, it's telling you also the volatility is likely is going down. In that case, you can revert to your normal stop loss. Again, in all cases, trade on the edge of a normal trend line, of a common sense trend line. You see here, it's rushing down very fast. If you are chasing it like this, volatile, you have to use a bigger stop loss. But somebody who is trying here, you see here, okay, all right, where am I? Okay, this section here, okay, I talk about this, okay. Somebody who is buying on the edge, okay, will avoid all the mess. But sometimes you can, if you look carefully, look at this section here, okay. Pay attention to the ATR here, okay? Okay, so you see here, look at this section here, all right? The ATR is telling that the volatility is low. It's going down. The volatility is going down. But look, is the price not volatile? It's volatile. Can you see that? Long candlestick bar, though the ATR is going down. So when the ATR is reverting from the peak, don't think that the volatility is definitely going to be low, because the low is somewhere here at the bottom here. But if it's going down from the peak, going to the midpoint of the range of the ATR, it can still be volatile. So you can see, you see this section also, look at this section also, all right? So it was at the peak For this one, it's 1.6. All right. As it's coming down from 1.6, it doesn't mean that the volatility straight away will be low, because until it goes below the mid range, so the volatility is from the high, the peak, to the low. So the volatility will become truly low if it crosses the median line of the range of the ATR. So you see this section here, though the ATR was going down from the peak, it didn't cross the midpoint of the range of the ATR. Do you agree that this section here is a little bit volatile still? You see, it's still volatile. But the ATR said that the volatility is likely to go down. But remember that when you are using the ATR, you should pay attention to the peak and the low. So for the this one, we can say that the low on average is somewhere near 0.79. Okay, so the midpoint will be between 1.6 and 0.79. Yes or no? So as it's going down, it will, as you see here, this section, as it crosses the median line of the range of the ATR on the daily chart, not weekly chart, no monthly chart, no 5-minute time frame, no 10-minute time frame, daily chart, crossing the median line, the volatility is likely to become low because it's approaching the lowest point of the ATR. So all in all, all right, for instance, if you are trading, if you ask me, okay, what should be the minimum stop loss for the pound yen for day trading, I would say between 35 and 40 pips. Sometimes you will have to use even 50 pips. All right, personally speaking. All right, I talk about the euro dollar, the euro British pound, the Australian dollar. 30 pips generally will help you. But I'm referring you back to the playlist talking about how to set stop loss, because there are different strategies that we use when we are setting stop loss. But if you are somebody trying to avoid using bigger stop loss, especially if you are day trading, you want to use the minimum 15 pip is great sometimes, because if you are day trading on the edge of a major trend line, major key levels, at the end of higher time frame pitchfork tools, you are likely to minimize your risk. All right. So a financial instrument that is going up, all right, is usually in a rising channel. In order to minimize your risk, you are likely to enter the trade on the lower part of the rising channel. There is another place that you can enter the trade when the price is going up in a rising channel, is when the price is retesting the prior high. The opposite is also true in a downtrend. When the price is going down, the best place to minimize the risk or to use a reasonable stop loss is on the edge of the upper level of the declining channel. Sometimes it will be when the price is retesting the prior low. So you see here, so see this section here, you see here, so there was this low here, and the price break below, there was this low, the price break below that low, and it was retesting here. This is a low risk entry point to enter the trade to sell. But if you are chasing it down, sometimes it may be volatile. So those are the things that I need to point out to traders that are interested in using the ATR. I will be recording another video when I can show traders more. We will talk about the ATR, the average to range of Mr. Wellis Wilder. All right. So I hope I have managed to answer your question. So again, when it comes to setting stop loss, it's all individual to your trading style. Sometimes they may say to me, "You're using 30 pip for day trading. Are you crazy or what? I use 5 pip. I use 10 pip." This is another trader. Another trader may say, "I use a 20 pip." Some traders use the same stop loss, okay, all the time. All right. So whether they are taken out, they're going to replace the next trade, they will use the same stop loss. So we talk about that in that playlist that I was referring you to. So if you have any more question about the average to range, okay, let me know in the comment section and we can come back to it, all right, to discuss it more. So the calculation, generally speaking, when we are talking about average to range, we do the high minus the low. Okay, but sometimes we can use also the high minus, okay, the low. All right, now that the normal one is a high minus the low. Sometimes we use the high minus the closing price when the price gap up. So the price gap up, all right. So it closed somewhere day before. Now it gap up. So the closing price of the previous day, okay, we'll use the high of the next day minus, okay, the closing price of the previous day. But if the price gap down, in that case, we'll use, okay, the low minus the closing price. So if you are interested in reading more or knowing the theory or the calculation of the ATR, there are many articles on the web about ATR, but that's not my area. My area is about telling traders how practically, when we are day trading, we are swing trading, how can we use the ATR? This is what I do care about. The ATR is primarily designed for commodity trading, not for stock, not for commodity, not for indices. But today, technical traders use the ATR for all financial instruments. When you are using the ATR, use it only on the daily chart. Otherwise, you are doing something else. Highlight the peak of the ATR on the daily chart, as I did here. Just pick, there's a peak here, all right? And highlight the low. And also highlight the median line of the ATR. Understand that when the ATR reaches the peak, it's likely to reverse, okay? It will reset itself. But as it's coming down from the peak, remember that the volatility can be still high until it reaches the midpoint, all right? So the volatility will become totally low if it crosses the midpoint of the range of the ATR, all right? So those are the things you want to really understand. On the other hand, when the ATR reaches the low, you see here it went below the low, all right? You can see that it's oversold, the ATR itself is oversold. There's a high chance that it's likely to go up again. So as we see the ATR reaching the oversold zone and turning around, we will be preparing ourselves knowing that the volatility is likely to increase. The best approach in that case is to just concentrate on trading on the edge. That will save you all kind of trouble. Because if you start jumping and placing trade anywhere, anyhow, as the ATR is increasing and the volatility is increasing, you may have to use a bigger stop loss, or even they will take you out many times, and then you'll be wondering what's going on. Like today, all right? Like today, I'll show you quickly what has happened today for the British pound yen, all right? Something is playing on the mind of technical traders, all right? What is happening? We are talking about the G20 that is happening in Buenos Aires. Is that a correct pronunciation? In Brazil? Is it, I don't know, Argentina. Buenos Aires in Argentina. So the G20 will take place on the 30th of November and the 1st of December 2018. So the market has been volatile. You can see there was a lot of here on the 5 minute frame, blah blah blah, a lot of volatility. Price goes up, it went up. So this is the British pound yen. Normally should go up. So you can see start going up like this. Okay, consolidated during the Asia session. As the London open, it went up. It's supposed to go up because of that. Okay, G20 meeting going on. The market were preparing themselves, and the volatility keeping people doing all kind of things. So they like this, all right, you may see all kind of things going on, and your stop loss will be kaput, it will be wondering. So the economy news, apart from the ATR, will also help traders to mitigate the risk and to decide whether they should trade that day or not. So like a day like today, or whatever, okay, when the non-farm employment data is about to release, you can decide not to trade at all. When major economy news that can move the market all over the place, you may decide not to trade. So instead of trying to determine the appropriate stop loss, if you know that it's going to be too messy, well, why do you bother to trade then? All right, you may, or if you're going to decide to trade that day, all right, which is good, sometimes volatility will help your trade, which means you enter correctly, boom, 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 5 minutes, 10 minutes later, you get paid big time, okay? If you decide to trade, you need to be very careful. You want to trade on the air. You don't want to place too many trades when the volatility is increasing. As always, with a bit of experience, so you're going to trial and tribulation, okay? So you will be, what I say to say, specialize yourself in financial instruments that you understand, that you like, and trade them. As you are doing so, you will be able to determine the characteristic of the financial instrument that you are trading. So you know more how that financial instrument behaves. All right? So you will know whether you need to swing trade, what kind of stop loss you should use. On average, if you use 30 pips on average for trading a financial instrument, if you are swing trading, you have to double that. So 30 pips for day trading. If you are swing trading, you will say minimum 60 pips. Sometimes you may use less even for swing trading, all right? The idea is to trade always on the edge. Because what is happening on the edge, a lot of traders are avoiding the risk, jump in the middle of nowhere, buy or sell. They avoid the risk. So you see here, the price was doing all kind of, you see here, so drawing a common set trade line, you see on the 5-minute time frame. Sometimes you say, oh, it's going down, but it's tricky now. What should I do? So you just, sometimes they play carefully. Some of the traders use only 10 pips. So they place 10 pips there, they sell it. 10 people, they say, when they are taking out, they don't care because they are using the same stop loss. So they will try again. They will try again. They'll try again. And then one time they try again, boom, they get paid for everything else that they have lost before. So all in all, practice, understanding the financial instrument that you are trading, all right, and understanding also what is the ATR for? It's for commodity, which time frame for daily chart, many calculation, high minus the close, or high minus the low, or low minus the close, and so on and so on. The ATR is all about volatility, nothing to do about the direction of the price. But there are more things that we can do with the ATR. If you are interested to know more, let me know in the comment section, and I will be back again recording another video to help you understand many other ways that we can use the average true range of Mr. Wellis Wilder. Is it my pronunciation correct? Am I speaking with my Texas accent today? Or is it with my Mumbai accent I'm using today? All right, let me know in the comments section. Is it the correct pronunciation? Wellis Wilder? Or is it Wellis Wilder? Oh, is it, okay, let me know in the comment section. All right. So we are recording the video today because a TSCW24 trader did send me email today, and because of that, we are recording the video to answer that specific question. If the video has been truly useful to you, please let me know by giving us your beautiful thumbs up. If you dislike it, be sure to mark it down. It is an essential tutorial that can help other technical traders. Feel free to share with your friend on Google+, on Twitter, and also on Facebook. All right, this video will be posted at the 24 Stock Trader YouTube channel. Subscribe to our channel. Be sure to click on the notification bell. So anytime we are about to live stream, a pre-recorded video, you will be the first person to be notified. And usually when I'm live streaming pre-recorded video, I'm watching it myself. So if you have any question, you can ask me as the video is being played. All right. Subscribe to our channel today and stay put. More tutorials are coming soon. Until the next time, enjoy yourself and be very happy. We are the TSGW24 traders talking about a technical trader reflects upon the average terrain of Wellis Wilder. The ATR technical indicator is not a directional technical indicator like the RSI or MACD. Thank you for watching, and I will speak to you soon. Happy trading to you all.